hear me?
Yes.
Oh, yeah. Sorry, I thought I had the mic on. Yeah,
Oh,
there was a good discussion on CNBC, and this one guy made a really strong case for the next 2 or 3 years, no inflation. But at the tail end, as we start to come out, because of higher taxes and a whole bunch of things, that we should start to see some inflation.
yeah. It'll be interesting to watch it play out. There's a lot of counter forces that'll end up happening. Okay, so I'm going to kick it off because we are at 2:02. So welcome everyone. Welcome back. Thank you for doing this on a bi-weekly basis. Greg and I have talked about the fact that there's a pro and a con. There's now a lot to talk about, but it was nice to take a week off and be able to focus last week too on the companies and on the portfolio. So we're grateful for you doing it every other week. With respect to the firm and what's going on here, we are starting a very slow reopening of Gilman Hill. And we're doing that according to Connecticut guidelines for the most part. Maybe we're starting 2 days early. But what we're doing is we're bringing Michelle back on Monday and Tuesday. And then Ashley will come back on Thursday and Friday. And then next week, Andrew will start to come in every day. So at that point, we won't have any more than 50% of the people here at any one time. And some days it'll be like 33% of the people. So that seems right and good to us. We have the space to lay it out. Andrew's going to work from a conference room. From an office. Jonna and I are in offices. Michelle or Ashley will be in the common space. And then we've got protocols in place for like going to the bathroom and using the refrigerator and using the microwave and all of that. But it is a 2,500 square foot office. So we do have the room to spread out and keep a lot of distance and feel really safe and confident about that. I hope that you and your families are doing well. Hopefully you guys are all getting a little bit of socialization back. This past weekend, we had friends show up on their e-bikes, and it was just neat to have someone show up, and we were able to chat with them from a distance. But it was a welcome relief to see faces other than our own. So that's it. With respect to over the last 2 weeks, there have been a lot of developments, both on the macroeconomic front as well as the company level and the portfolio level. So I'm going to start on a couple of things, and then Greg's going to go into more news and more of what we're hearing, and then we'll bring it to the portfolio from there. So what I think is really interesting is, except for last week, we've done these calls weekly, and it was 1 month and 1 day ago that the oil prices were in such unbelievable dislocation, where oil traded actually into negative territory and was trading at almost negative $40 a barrel. And I think it's remarkable, indicative, and telling what's happened in a mere month. So in a mere month, here we are a month later. Now the June oil contracts are expiring. It's been completely regular. That's not the right word I was looking for. Orderly. Orderly is the word I was looking for. It's been completely orderly, completely normal. You would never notice that these oil contracts are maturing, which you never do at any other point in time besides 1 month ago. In fact, the price of oil has come back to where it was just when the shenanigans with Russia and Saudi started in the middle of March. Actually, I think we're a little bit above where it traded right after that all began. So one of the things, Greg and I don't know if I can convince him to do this with me, but I'm trying to convince Greg to write a letter with me to our future selves, so that if we ever go through something like this again, we can refer back to our letter to our future selves. And it'll include things like trust the process. And it'll also include things like, don't forget, the cure for low oil prices really is low oil prices. And even if it seems so crazy in the moment, that really does solve the supply issue quite quickly. So it's been interesting to see price discovery and normalcy and a sense of order start to come back into the market over the last couple months and I would say mostly over the last few weeks. So that's been really nice. With respect to the reopening that we're seeing not only in our office, but in our towns and across the country and in all of your towns, I don't know that we have too much to add there. I think that on that subject, everyone on this call and probably everyone in the country, including my kids, are kind of equal experts on that. So we're not gonna get too into that. One interesting thing, I don't know if all of you know this or not, but I'm on the board of trustees of my alma mater, which is Hollins, and it's a really small all-women's school in Virginia. And it's interesting to see the way the colleges are reopening and the advantages that the small ones have over, say, like California State. One interesting thing I saw yesterday was Notre Dame announced that they're reopening. And what they're doing, which is so cool, is they're starting classes a few weeks early, they're canceling their October break, and they're sending everyone home in November. And so they'll get the same amount of class time in, but they're just rearranging the schedule. And that seems really smart to me. Jonna, our partner, said that a few of the other schools started to follow suit with that too. I think she said Boston College is doing the same. So it's interesting to see the creative reopening start to happen. Okay, with that, I'm going to pass it to Greg to chat for a few minutes about all sorts of cool stuff that we've seen and learned over the last few weeks.
Yeah, the comments from we got a lot of comments from companies during earnings season, which I think were really quite interesting. One of the big themes we're seeing is that, you know, for some companies, things are actually not that bad, and they're seeing sales go up. And even in the hardest hit companies, I think all of them are talking about how there's been a steady improvement since the beginning of April, that they're all commenting that the end of April was stronger than the beginning of April, and May has been much better than April. Even there was an interview with the CEO of United Airlines this morning. You know, even though air travel is down significantly since the peak, they've gone from at the minimum, at the worst level, they were having about 10,000 passengers per day on United flights. That's actually rebounded to 35,000.
Oh wait, tell them what it's down from.
Still far from the 500,000 passengers a day that they normally travel, but that's a big sequential improvement, that things are starting to get better. Stores that are open seem to be doing quite well. We had Walmart announce that the same-store sales were up 10% in the last quarter, and they also said that as the quarter went on, things got better. You know, they've seen a different cycle of what's been selling in the stores, which I thought was really interesting. How at the beginning of the outbreak of the virus, it was people stocking up on food, sanitizers, cleaning supplies, paper products, and then that, you know, once people were stuck at home, that shifted to more spending on activities at home, so arts and crafts, toys. Now that's into the latest shift they're seeing is a run on adult bikes. They're completely sold out of adult bicycles. So the types of goods people are spending on are changing as time goes on, but they're still seeing strong sales, and sales have been improving over the course of the quarter and continue to improve. They did note that they saw a huge difference before the stimulus checks went out. Walmart said that they were starting to see people cut back on discretionary purchases and buying off-brand goods instead of name brand goods, and buying things in smaller quantities. They could see that there was some pain with the consumers, but once the stimulus checks went out, they saw a quick rebound in spending on discretionary items, and people returning to more normal purchasing patterns. So that they see that there's a pretty big impact from stimulus checks, and which would be a good sign, because it does seem likely that we're going to get more stimulus checks soon for retailers. And elsewhere, it's not just Walmart. Target had good numbers. The home improvement stores had really strong earnings numbers. Well, not earnings, but the sales numbers, which is remarkable, you know, considering that the stores have limited hours.
So
construction is
just clarify that you're talking about Home Depot and Lowe's.
Yeah, the home improvement stores. So Home Depot sales were up 6.5% in the quarter. Lowe's was up 11%. That's with limited hours, limiting the number of people allowed in stores, and also construction in most states is still there's still strict restrictions under construction. So it just shows you how much consumers are wanting to spend on their homes. Obviously, it's not all areas of the economy that these big box stores have an advantage over smaller retailers, but we are seeing some strength in certain areas of the economy. As far as the other macroeconomic data, it's pretty bad. The April numbers are not great, and we're seeing, as we've said before, they're shocking, but not surprising. The one I would want to point out is it gets a lot of headlines in the media is on the labor market. The The unemployment last month was 14.7%, which is a shocking number. And every Thursday we get the reports of how many people filed for unemployment claims, jobless claims, which this last week we got another 3 million, which brings the total to jobless claims to 36 million over the 8 weeks of the since the stay-at-home orders were put in place. While that's a terrible number, I think what gets overlooked, and as you look into the data, even though 36 million people have filed for unemployment claims in this past week, only 22 million are still continuing to get unemployment claims. So 14 million people either were wrongly filed, didn't qualify, or have returned to work. So I think that remember when you see the number being reported in the headlines, how terrible the labor market is, remember that's only one side of it. That's the people getting laid off. The other side of it is that there are people getting rehired, and the labor market is starting to improve from a very low level. So just to keep an eye on those numbers, that the labor market may be actually better than people think. And also within the numbers, it's low-wage workers who are a large portion of the cuts that are taking place. So it's not as a percentage of the total wages, it's not as impactful as the numbers may indicate. Also, in most states, the unemployment benefits with the extra money from the federal government, unemployment benefits for lower wage workers are actually higher. You're better off being unemployed than working.
Right.
This time it's also this round of unemployment, it's different than past cycles, that it's more likely that a lot of the people who are being laid off will be rehired fairly quickly when the government shutdowns are taken off. As far as policy, the Fed has been quiet, but Jerome Powell has made a lot of big speeches that have been watched closely. He keeps reminding the market that they have plenty of ammo, but he's been encouraging them to enact more fiscal policy. It does seem likely we're going to get another fiscal spending plan passed fairly soon. We think within the next 2 to 3 weeks. The House passed a $3 trillion spending package on Friday. It doesn't look like the Senate is going to agree to that plan. So the negotiation process is starting, but hopefully soon that they will start to come to an agreement on that.
And I want to say one thing on this. So one of what will be the most contentious parts of this new round of fiscal stimulus will be the extension of that unemployment insurance by the federal government. So I assume you all know this, but if you file for uninsurance, you go to your state, you get whatever your normal, unemployment insurance, I said uninsurance. You go to your state, you apply for unemployment insurance, you get your unemployment, and then the fiscal government's kicked in an extra $600 a week. And starting at the end of March, they said that they would do that for 4 months through July. And part of the new plan is saying we want to extend this through January. And it's very politically divided. Like the Democrats are behind it and the Republicans are saying absolutely not. What I think is interesting, and this is purely personal, is my brother has an ice cream company in New York City. And I was chatting with him last weekend and I said, hey, Benj, why don't you get the trucks out on the road? Because that's I know all these food trucks are doing great businesses. Why don't you get your trucks out on the road in the city and all around? And and that's a great way to sell ice cream and drive sales in this socially distanced environment. And he said that it's impossible, that he can't, because it's impossible to hire, and it's impossible to hire 4 people to run the trucks because they're making more money staying at home on that $600 a week. So I thought that was really interesting and insightful. He said, just as an aside, that he was upset that he'd laid people off right off the bat and wishes that he'd furloughed so that he could have had them in his pocket to bring them back to run the trucks now. So I can see both sides of the argument of the $600 extending for longer. And I can also see the argument through my brother's eyes of, and he didn't say he hopes it doesn't happen. I'm not putting those words in his mouth, but just through the employers who can't bring people back, I can see the argument for removing it. So, okay, sorry, I'll give it back to you, Greg.
Just on the virus, a quick update on where the virus stands. I'll highlight some of the things we wrote in the letter on Friday. with 50 states and thousands of counties around the country, the media has a large amount of data that they can cherry pick to fit whatever narrative they're trying to sell. So sometimes when I see headlines, they're very different than the reality that's taking place across the country. And the reality is that the story on the virus is actually in some ways boring, in that there's a modest improvement every week, and cases fall 5 to 10% per week, and the number of tests rise about 20%, which doesn't make for a very exciting headline, as opposed to saying, oh, there's a spike in cases in Texas, the resurgence is here. That sells more papers. But the reality is that when we look at the progress on the number of cases of the virus since the beginning of April, you put together the continuous weeks of just constant improvement, the number of confirmed cases is now down about 25% since the beginning of April, which doesn't sound like a lot, but in that time, we're now testing 4 times as many people as we were at the beginning of April. So we've gone from testing 100,000 people a day to now almost 400,000 people a day. And yet the number of cases has still fallen during that time. So the positivity rate, the number of people testing positive, has actually fallen from I think the peak was, my data here, it was 20%, and now I believe it's down to about 10%. So the positivity rate on cases has fallen quite dramatically. Even, it still continues to be a terrible human tragedy with the virus, but the number of deaths per day has fallen about 30% from peak level. So there is progress being made on the virus. So be careful when you see media reports that don't include the amount of tests being run, that there's a huge increase in testing. And then when you test more people, you're going to find more cases of the virus, which is good. We want that. We want to see them finding the cases of the virus with testing, but we do want to see the positivity rate continuing to fall. As far as on the treatment front, vaccines, we got a very big piece of news on Monday. Moderna released their part of their phase 1 trial results, which were quite positive for their vaccine. There were no adverse reactions. There were no significant adverse reactions in the group of the 45 people who took the vaccine, and of the 8 patients that they had already tested or run blood tests on, they found that all 8 had produced antibodies. So it looks like, from the preliminary data, it's a very small sample size, but it does look like the vaccine has indications that it could be safe and effective in producing antibodies. There's still a lot of more testing to be done. They're going to start phase 2 testing. Phase 2 trials are starting now, and phase 3 trials are scheduled to start in July. So that's moving really fast in terms for a vaccine development to go from the lab in January to phase 3 trials, possibly starting in July, is really amazing progress. And at the same time, they're ramping up production. They're working with a Swiss company called Lonza to potentially make the vaccine at a rate of 1 billion doses per year to supply the world. Now, they're not the only ones producing a virus. There's a vaccine. There are 8 vaccines currently in trials, in human trials right now around the world. Another big one, the Oxford University AstraZeneca partnership, they're starting phase 2 trials. They announced that in the past week. So there's progress being made there, and there's several other notable companies also in the middle of phase 1 trials as well, which we should be getting data on very shortly. So there's a lot of progress on the virus. The government on Friday announced their program. They're calling it Operation Warp Speed, which essentially is going to provide funding for the most promising vaccine candidates. What the government is trying to do is ramp up manufacturing now before approval of the vaccine. Because what you don't want to have happen is develop a vaccine, get it approved, and then wait 6 months for them to actually manufacture it to give to people. So they're investing the money to manufacture the vaccine now, with hopes of having a vaccine in production by year end. And not in production, but also approved and produce a significant amount of it by year end. We'll see how successful they are, but it's a pretty ambitious target. but that's what's necessary to get a vaccine produced quickly. We're going to get a lot of data on vaccines and treatments in the next few months. There's a lot of treatments that have been in phase 1, phase 2 trials. We should be getting the readouts of those data. So it's going to be a busy few months for the scientific community to see what works in treating the virus. And within that, the odds are that there should be some good news. And in addition, we see how the market reacted to the Moderna news. There should be other companies with success as well. And that's been the news for the last 2 weeks.
You're becoming an excellent anchor man. Thank you. Co-anchor. Okay, so now we'll move into a little bit more of the portfolio and the market. I think even though there will be good news coming out, there's probably going to be bad news too. There's probably going to be disappointment. The economic data, as we mentioned, is probably going to be pretty ugly. I think there are strong arguments that I've heard on both sides for economic activity to return to 2019 levels in 12 months. And I've also heard equally compelling arguments for it to return in 60 months, so a year or 5 years. And only time is going to tell us which of those arguments turns out to be accurate. So what my guess is that we're in a period of consolidation for the stock market and the portfolio for the coming months until there's real substantive new rounds of data that come out, and until we get to the second quarter earnings reports and can look back at what actually happened in April, May, and June. So with that, I'll move into the portfolio. For the equity income portfolio, earnings are complete. All of our companies have reported, and frankly, it was better than feared. And I wonder if it was better than feared because I'd lowered my bar so much in terms of what I was expecting. But by and large, most of the companies in the portfolio fared pretty well and have pretty decent outlooks ahead. Just last week, we got our kind of final nugget, rather, technically speaking, just yesterday, we had the very final nugget, which is H&E Equipment, one of the companies in the portfolio that had been on the watch list, something I was really worried about, reported earnings last week, and it was a lot better than expected. They were able to stand behind the dividend, said even if this sustains for a long time, the cash flow is there, the dividend, they can support the dividend, and business isn't nearly as bad as I expected that it could be coming out of this. So that was the final one to report, and that's now moved off the list of things to worry about and into a comfortable continued long-term home in the portfolio. As you probably saw, we added 2 new positions last week. We added Viacom and Unum. Actually, sorry, that was the week before. These times are messing me up constantly. I've been joking that each week feels like 5 minutes and 5 years at the same time. So we added Viacom and Unum. Viacom, everybody knows that's Viacom and CBS. And so they own things like Comedy Central and Showtime and Paramount Pictures and all the CBS stations. It was really an interesting research process to get into that and to see the difference between what the share price was trading at and what the actual sustainable cash flows are, even in an incredibly distressed and continued distressed environment. Even with that, the cash flow that this company produces is unbelievable, and their library of content is incredible. It's everything from like Raiders of the Lost Ark to Star Trek and to the whole Star Trek series. So they have amazing value in that content. One of the other interesting things in researching it was learning how they're able to control their expenses, for better or worse. But basically all content production, all filming and all TV has been shut down, which I would argue makes the existing content more valuable, but it also reduces the expenses because nothing's being produced. One of the interesting things, I don't know if you all saw that movie, A Quiet Place, that came out maybe a year or 2 ago, but it was wildly popular. And they've got A Quiet Place 2 coming out. And it was interesting researching this and listening to how they're being very careful with the timing of when that will be released now to maximize revenue when they do let it out. So that was Viacom. We're off to a really good start on that one. We also added an insurance company. I know we've talked about that on this call before because several of you had suggestions for me to look at on insurance companies, and it ended up being Unum that we bought. And of the 6 that we looked at, which included all the suggestions from all of you, of the 6 that we looked at, Unum was the only one that was able to grow revenues, grow earnings, and grow the dividend from 2007, so through all of 2008, 2009, and into now. We're kind of flat on that position, but it's got an 8% yield, and I'm quite certain that we're going to make a lot of money on it, and got really lucky on a nice entry point. So I'm feeling great about those. The next likely addition to the portfolio will be Broadcom. The ticker is AVGO. And they're kind of like Qualcomm, but a more diversified business. It's got just shy of a 5% yield. And the reason I want to highlight that and why it's not in there yet is what's been so challenging over the past 2 months is pairing up the timing of what to sell with what to buy. So that needs to be made at every point in time. So like last week, Broadcom was in fact at a price that I was willing to pay for it, but what I would have had to sell to fund that position had, in my opinion, and thankfully it's played out to be correct, significantly more upside potential than Broadcom did at that point in time. So then I have to make the decision, no, I'm going to continue to hold the sources of cash, which are all the obvious ones that we've talked about in the past, General Motors, Ford, WestRock, Covanta. Those are the ones that we just keep selling off as we need the cash. But I need to, at that point, at each point in time, say, if Broadcom has this much upside and General Motors has this much upside, at this point in time, what makes more sense? Buy Broadcom or continue to hold GM? So each decision that I'm making is pairing up all of these opportunity costs of hold or sell. And it's challenging, but so far it's been going nicely. The portfolio overall has been having a good quarter. We're ahead of the market, as we certainly should be after such a rotten first quarter, but it's nice to see that that's working. The income remains really strong and really solid right now. I feel like what's in there has been truly stress tested. Most of these companies have now made it through both 08, 09, and now this pandemic, with the ability to continue to generate strong cash flows and protect the dividends. So I'm feeling really good about the portfolio. I think one of the interesting things, given that we've been doing these conference calls for just about 2 months now, is that it was the right decision to hold on to so many of the eyesores that would have felt, maybe emotionally would have felt better just to kick out right away when things got so ugly in March. But many of them have seen significant recovery. And so it was the right decision to hold those. It's like I said, it's all about the opportunity cost. It's all about minimizing the losses, maximizing the return, and playing those off of each other. So that's where we are. So we'll still end up with a portfolio coming out of this with probably 30 to 32 companies. The yield right now is a little over 7%. So we're in pretty good shape, all things considered. Greg, you want to give us updates on your portfolio?
Yeah, I'll start with the growth portfolio, which has had a really nice rebound since the beginning of the quarter. The portfolio is up about 20% after a very difficult first quarter. Earnings season is almost over for the for the companies in the growth portfolio. We're waiting on a few more, but most have been better than feared. Is probably the best way to describe what the earnings season has been like. New companies are either reporting stable businesses, or if there are impacts from the virus, they appear to be manageable. I think all the companies we have in the portfolio have the balance sheet to get through this, and I think in many cases will emerge stronger as a result. We did make one trade last week. We added a new position in Intel. Intel is a company I'm sure most of you know. It's in their chips are in a lot
in your
of the products
laptop
that
you're watching this on?
Yeah, it's being used right now. Intel, we get the opportunity to buy Intel at 12 times earnings, which I think after the virus is over, we're going to look back upon this time and see how resilient the earnings were in Intel. And because the sales of laptops and PCs are doing quite well, offsetting some of the weakness they're seeing in the chips for the server market. And they've managed the virus very well so far. And that a company with that type of resilient earnings and still stable growth deserves a higher valuation than 12 times earnings. In addition, they also have, I think, which is completely unrecognized by the market, they own 100% of a company called Mobileye, a company out of Israel, which is the leader in technology for autonomous driving, for self-driving cars. And they're making some just amazing breakthroughs through that company. And that's completely unrecognized by the market. If this was a standalone company, it would be worth probably tens of billions of dollars, given the technology they have. So I think that's not being recognized, and that will be valued into Intel over time. To fund the purchase, we trimmed part of our Home Depot position. before the earnings, which was the case. We still like Home Depot. It's just expectations are really high for Home Depot, and it also became because it's outperformed. It became a position size that's just too large for the portfolio. Was for standalone growth portfolios was over 7% of the portfolio, so it was time to reduce that. And we also sold out of a company called Mohawk, which is the leader in making carpet and tile floors, which had been struggling before the virus, and the virus has been challenging for them, and they've got a significant amount of debt, and I'm afraid the recovery and projects like flooring and carpets may be slower to recover than other areas of consumer spending. So we sold that to fund the Intel purchase. As for the international portfolio, we're still trying to get our hands around why international stocks have lagged U.S. stocks. A lot of the large companies in the international portfolio and international markets are global companies, and that have the same business exposures as companies in the U.S. market. Yet,
same geographic.
Yeah, geographic. The year to date, though, they've lagged by about 9% this year, the returns of the S&P 500. So why is that taking place? Especially given an environment where the outbreak of the virus has been significantly less in Asia. China has been on the path to recovery for a while now. There's been less of a viral outbreak in Korea, Japan, Singapore have had less exposure to the virus than Europe and the US. So why are those companies being punished more than their US counterparts? So we're still working on that. It does appear valuations are really cheap. Yields in the portfolio are still well above 5%, look very attractive from here. The companies are, a lot of these markets tend to be a little bit more socialist leaning, especially Europe, where companies are less likely to fire or furlough all of their staff during the virus. So the economic data is actually, should hold up better in Europe and in Asia than it does in the US. But despite that, they've still lagged. We think it's a good opportunity to buy, and there's some attractive valuations across these companies, and the earnings season has been pretty good. The companies have maintained their dividend, or some with flexible dividend policies have reduced their dividend, but the most of the portfolio has maintained their dividend and still looks attractively valued. So we're confident on the outlook, but just questioning why they've lagged so far year to date.
Mm-hmm.
And that's my portfolios.
That's it. Okay. I'll take it back. I don't know if this pinning of the videos actually works or not. So I think that's about it. I'd love to open it up to questions. If anyone has any, please feel free to ask. If you don't, I have a little vignette I'm happy to share that we've seen over the past week. So first I'll say, if anyone has questions, please go ahead and unmute yourself. You can do *6 if you're on the phone to unmute, or just click on the little microphone button on your iPad or computer if you're logged in that way. So I'll give it a sec. Anyone got questions?
Hi, Robin.
Hey, Robin.
It's the International Fund year to date against your benchmark net.
Doug, could you hear that?
Question: the performance of international versus the benchmark. Did I hear correctly? Let me see.
I think so.
Yeah, it looks like we're down. This is unofficial numbers, down through yesterday about 22.5%, and the index is down just under 18%. So we've lagged behind the benchmark a little bit as high yielding companies have lagged the market. Markets favored growth companies, and then the benchmark has trailed the returns of the S&P 500 so far this year.
What is benchmark?
We're using the MSCI All Country World Index, excluding the U.S. So it includes both developed markets and emerging markets.
Was that net or gross growth?
That is gross of fees.
So it's 23%.
Yes.
Anyone else got questions? Oh wait, Robin, was that helpful? We can follow up with you on your specific one, on your specific portfolio too, if you'd like.
Sure.
No problem. Okay. Anybody else? Don't be shy. You know, I love the questions.
Well, okay. I guess what I'd be curious about is kind of the two views of the economy that have been floating around. I mean, you've been saying that things are going better than expected, and at the same time, you've got, you know, Jay Powell talking about how there may be lasting damage, and obviously nobody really knows exactly. But how do you? I'm trying to figure out my expectations of, you know, since I'm just starting, I'm kind of putting my money in pieces. Or I guess you're putting my money in pieces. Anyway, how do you decide over what period you can determine that, okay, we really do have a better idea of how the markets are going to match up with the economy? Because the markets are obviously way ahead of where it looks like the economies are right now.
Right. So I don't know if you were on, but just at the beginning of this call, I was chatting with Gary, who at the end of the last call asked about inflation. And I referenced this terrific piece that I read this morning. It was in Business Week, and it was an interview of Ken Rogoff and Carmen Reinhart, who are Harvard professors. And one of the things that brought me comfort in reading that is that you have these two absolutely brilliant minds discussing your question exactly, right? And they're the ones who, coming out of 0809, wrote that book. It was called like This Time is Different. And then there was kind of tongue in cheek because it's obviously in many ways it's never different. But what I found interesting about that is like, these are the most brilliant minds out there and they don't know, right? They don't know if we're gonna have deflation or inflation. They don't know if it's gonna be 12 months or 18 months. What we all know is that the market is not reflecting the economy. And we also know why. We know that it's not reflecting the economy because there's been unbelievable monetary stimulus by the Fed that's put a floor under the market, in addition to which 20% of the S&P is basically 4 or 5 companies, depending on how you calculate it. And those 4 or 5 companies are relatively immune with massive, I would argue disproportionately massive market capitalizations that drag the S&P 500 up. So what we do to make these decisions in all of your portfolios is look at each company from its own level. And when I say things are a little better than expectations, that's why I say I think that not just our bar, but probably most investors' bars out there, most market participants, like that bar got reset really low in those dark days of March and April. And it seemed like it kind of just felt like everything was ending. It was totally terrifying. So what we do is we look at each company. Right, and when I add a Viacom or when I add a Unum, I don't need to have a huge macro backdrop to support the investment in those companies. When Greg added Intel and trimmed Home Depot, he doesn't need to have a huge macroeconomic backdrop to support that decision. You can look at the company and you can go back to, you know, I mean, with the technology now, we literally can go as far back, but for us, let's say we go back to 2007 and follow it through 08, 09, and we can look at what happened to their earnings and revenues in a sustained, prolonged, horrible, high unemployment recession then, test that against what's happening now, consider the differences and similarities now, and make individual investment decisions. So to me, this is the beauty of being able to buy an individual stock portfolio, is that you don't need to have the macro part precise, right? We're not just buying funds. We're not buying funds that depend on the market going up to keep it sailing along. We can buy individual companies. We can see what those companies' cash flows are most likely to be, whether it's, you know, good or bad, or 12 months or 60 months. We can see what those cash flows are likely to be. We can know that we've got income flowing to us, or that the company has income flowing to them, and that'll sustain them through this. So it's, you know, it's company by company, the way we're investing and the way we're making the decisions. Great question. Anyone else got any? Wow. Someone's got something going on in the background. Okay. I'm gonna give a last call on questions, and then if no one has questions, I'm gonna share with you just one little thought from a conference call that we had earlier this week. Anybody? Okay. So one thought from we work with a lot of institutional advisors also who hire us just to manage their clients' individual, just to manage their clients' dividend income portfolios. And a lot of them, it's kind of interesting. A lot of these institutional guys, so they're the ones who manage people's portfolios and then parcel little bits of them out. So they've been asking, there's been a lot of attention on the dividend income strategy by the institutional investors that we have. And one of them said to me, can we do a call with my whole team? And can you give me the reasons to re-engage? And this is a much bigger relationship, and then it's one person at this firm who kind of started maybe like 5 years ago and then fell off the radar, had some health problems, etc. So he said, can you give me reasons to re-engage? It was an interesting thought process for Greg and John and I to work through it. And this is what we came up with, which I think is the right way to think about the dividend income strategy now, which is $1 of income right now is at a massive discount to where it was just 2 months ago. $1 million invested 2 months ago would have produced about $55,000 a year of income. Today, that $1 million produces $71,000. We are quite certain that the disparity between our portfolio and the broader market will close. But we don't need the S&P to go up for us to come up. And we've seen proof of that in these days where there are large moves in the market. So when the market's been up a lot, we've usually been quite a bit ahead. And what that says to us is that it proves to us that the companies that we own are perceived as wildly oversold as they're picking up more on the up days, which is really interesting. The other thing that we think is interesting is that this crisis has proven to us how sustainable and how important the dividends are to the companies that are paying them. And we've seen that through language on the earnings calls, through the cash flows that are able to sustain them, through the commitment, and frankly, to some of the bigger companies like the AbbVies and Pfizer's and AT&T's and Verizon's and IBM's, seeing money flow into those companies. Once the crush of the craziness of March was over, they were the quickest to recover. And we're pretty certain that consistent dividend income stream is of value. So let's see, what else did I have on that list? Nah, it's just kind of repetitive. Sorry, I had a few more repetitive things, but that's what we've been talking to the advisors about, and how we view, like, right now for the dividend strategy to be one of the best buying opportunities that we've ever seen in it. The prices that we're able to pay for things, again, referencing back to Seagate, Viacom, Unum, these prices are unbelievable that we are able to get in at these companies. And so we think that as we dig out, and we are digging out, we've had a really good quarter so far, but as we dig out, those companies will continue to help bring the overall portfolio back up, both in terms of capital appreciation and the income that pours in to support the overall return. So that's it. I hope this is helpful. You know that you're all welcome to follow up with calls, emails, questions. I'll give it one last call on any questions. Anyone got anything?
And I have one.
Oh, hi, Gary.
Viacom trades at a ridiculous low PE. Is that because the family owns 80% of the voting stock?
I don't think that's why. I think it has to do with leverage. In some ways, well, let's see, where do I go with this? So as we've had calls with different companies, and this was not part of the call with Viacom that we had, but as we've had calls with different companies, I'll say to them, like, does it make sense? Do you know anything about why your share price is trading at this? And, for example, when I was talking to CenturyLink, they said, yeah, right now there's an algorithmic sell program on that looks for companies with leverage of 4 times or in the 4 times range, and it just sells. And Viacom kind of triggered on a number of those. So maybe the family ownership could have been a sell program. I don't know. But I think leverage was one. I think the fact that they get a decent amount of a lot of the revenues from advertising was a big one. But I think it's misunderstood. And it was interesting and challenging doing the work on it to see, I think, how sustainable the cash flows are through this. They're earning a minimum of $4 a share, or they should earn a minimum of $4 a share. Even with this, it's a 96-cent dividend, and it's trading at $20 a share right now. So it's really, really inexpensive. Even if I'm wrong on the earnings, and let's say they earn like $2 a share, and they're 50% worse than I expect now. And by the way, these estimates for $4 a share are after major stress tests, assuming for significant ad spending decrease. So I think they probably were the victim of sell programs more than anything else. I don't think there was a lot of human thought that went into selling those shares down.
Okay, thank you.
You're welcome. Anybody else? Okay, well then we'll wrap it up. Thank you all so much for entertaining us on this and joining us. We'll do it again in 2 weeks for anyone who wants to join. So thanks.
Really good call.
Thank you. Bye, everybody.
Bye.